What if the precious metal many investors view as a safe haven, silver, is not only underpriced, but is facing a shock so severe that it could destabilize parts of Wall Street, secretly stockpiled in paper contracts instead of real bars? What if the next big crash isn't ICT in equities or real estate, but in commodities disguised as safe bets? What if behind the calm facades of big banks and ETFs, there is a ticking time bomb that could detonate when enough people demand real silver at once? Today, we pull back the curtain on the coming of silver shock. The kind of meltdown few expect, but many can't ignore once it hits. Silver has had a long history as both a store of value and industrial metal. For centuries, societies used silver coinage and bullion to secure wealth. In modern times, silver plays a dual role, as a precious metal for investors and as a critical raw material for industry, especially in electronics, renewable energy, solar panels, medical equipment, and more. But unlike gold, silver's supply dynamics are far more constrained. Most silver mined today is not primary silver. It is a byproduct of mining for other base metals like copper, zinc, and lead. That makes silver's supply relatively inelastic. Even if price jumps, you cannot simply open new silver mines quickly, because the geology and economics depend on demand for the base metals. Since 2020, global demand for silver, driven by industrial and investment demand, has consistently outpaced combined mine output plus recycling supply. This structural deficit has deepened over time. At the same time, the rise of paper metal instruments, futures, options, and exchange-traded products, ETPs, has created an enormous disconnect between paper silver, contracts claiming ownership, and physical silver, actual bars or coins that can be delivered. Unlike in past decades when bullion holdings roughly matched demand, today the ratio of paper claims to physical silver is extremely skewed. This structural setup, growing demand, constrained supply, and ballooning paper exposure, sets the stage for a potential crisis, especially if a trigger forces many to demand real silver at once. The origins, how silver became a systemic risk. To understand the emerging crisis, we need to trace its origins. In the early 2000s and 2010s, silver was largely viewed as a secondary precious metal, overshadowed by gold. Many investors preferred gold for wealth preservation, while industrial users quietly consumed silver for electronics, solar, and industrial applications. Because supply was largely byproduct and stable, the market didn't face extreme shortages. But starting in the mid-2010s, several structural shifts began forming. Global push toward renewable energy and electronics expansion increased demand for silver for PV panels, semiconductors, batteries. Mining companies, facing declining ore grades and rising costs, delayed or canceled exploration for new silver mining, especially primary silver mines. Recycling of silver remained limited and too slow to offset the growing demand. Meanwhile, financial markets unleashed paper silver, futures, derivatives, ETFs, instruments that allowed investors to gain exposure without actually holding physical silver. That made silver investment scalable and attractive for speculators and institutions. This convergence, structural supply tightness, plus explosive interest in paper silver, laid the groundwork for vulnerability, what many failed to fully grasp. As more investors piled into paper silver, the total notional claims on silver started to vastly outnumber the actual physical silver in vaults globally. According to one recent analysis, as of mid-2025, total silver futures contracts, open interest, were estimated at around 1.2 billion ounces, while global mine supply, annual, was only about 830 million ounces, and COMEX registered, deliverable inventory, only a fraction of that. That's a leverage ratio, in effect. Imagine 33 paper claims for every real ounce stored. That kind of imbalance may appear fine as long as only a subset of contract holders ever demands delivery. But it becomes a crisis if many demand delivery at once, a classic case of systemic fragility masked by financial engineering. Over the years, bullion banks and major institutions, futures traders, hedge funds, ETFs, became comfortable with this paper-to-physical disconnect until recently. Rise, silver's recent surge and market euphoria. The stage was set, but the trigger came in 2024-2025. Global economic uncertainty, inflation fears across major economies, and renewed interest in safe haven metals led to a surge in investment demand for silver. At the same time, industrial demand continued rising thanks to expanding solar energy deployment, growth in electronics, increased demand from EV supply chains, medical uses, and more. As a result, silver flipped from being ignored by many investors to being hailed as a hidden gem. Silver ETFs saw major inflows, pushing total investor-held silver to record or near-record levels. For example, some reports by mid-2025 estimated ETP holdings around 1.13 billion ounces. Meanwhile, mining and recycling supply remained unable to catch up. The the structural deficit remained. Several market analysts projected the 2025 deficit at over 149 million ounces. Price began reacting. Silver rose from under $20 per ounce a few years ago to $30, $40, then crossing $50 in 2025. Spot premiums soared. Lease rates for physical silver, the cost to borrow silver for refiners or traders, spiked dramatically, indicating severe scarcity. For a while, traditional metrics like open interest kept rising. Those looked like bullish momentum, but underneath lay growing structural stress. By mid-2025, the disconnect between paper claims and deliverable silver became stark. Vault inventories in major trading hubs like London, LBMA, and New York, COMEX, started draining. Bar and coin premiums widened drastically. Delivery times increased, and physical dealers reported delays or out of stock for silver coins, chow and bars. This marked the early stages of what many now call a physical squeeze. Not a speculative bubble based purely on sentiment, but a real shortage of deliverable metal. Breaking point. What triggered the silver alarm? By late 2025, alarms began sounding in corners of Wall Street. One major signal was from Bank of America, BOFA. In an October 2025 note, BOFA's commodity analysts raised their silver forecast to $65 per ounce by 2026, citing severe supply tightness, extremely low deliverable inventories, and soaring lease rates as the main drivers. Why was this significant? Because BOFA is one of the biggest players in global commodities. Its warnings carry weight. For BOFA to go bullish on silver at a time when most money still flows to gold suggests the bank perceives systemic imbalance, not just a speculative fad. What exactly triggered the alert? Several converging stress points. Inventory depletion. According to industry reports, total registered silver inventories on COMEX and other major exchanges dropped sharply, from hundreds of millions of ounces to levels that market participants described as dangerously low. Backwardation and lease rate spikes. Normal futures trade at a premium over spot, reflecting storage and finance costs. But in late 2025, spot silver was trading above near-dated futures contracts, a rare phenomenon called backwardation, indicating immediate demand far outstripping supply. Simultaneously, lease rates for silver soared. Some reports cite up to 39% lease rates. Industrial demand, not speculative hype. The demand was not only from investors hedging against inflation, but real industrial use, especially in solar, electronics, and green technologies. As global economies push for energy transition, silver demand from PV and electronics sectors skyrocketed. Structural supply constraint. Because silver is mostly a byproduct, and mining companies have underinvested in primary silver mines due to low margins, environmental regulations, declining ore grades, new supply cannot ramp up rapidly, regardless of price. Together, these signaled a breaking point. The paper-silver infrastructure was becoming unsustainable under real physical demand pressure. In short, when enough actors demand actual silver delivery, the system risks collapse. Fallout. What happens when the bubble bust occurs? If a major silver squeeze or crash unfolds, what could be the consequences? Here are the likely cascading impacts. 1. Physical shortage and delivery failure. Exchanges like COMEX may struggle to honor delivery requests if registered inventory is insufficient. That could result in default on some contracts, or forced cash settlement at prices far below real demand-driven physical prices. Premiums on physical silver bars and coins could skyrocket, far above futures or spot prices. Retail investors and industrial buyers may pay steep markups or face long delays. 2. Margin calls and forced liquidations. Large institutions and hedge funds holding leveraged positions in silver futures could face margin calls if prices spike violently on delivery demand. Forced liquidations could worsen price swings, creating a feedback loop. Because paper exposure is so large compared to physical supply, even modest delivery demand could trigger outsized moves. 3. Industrial disruption. Industries reliant on silver, solar panel manufacturers, electronics producers, medical equipment manufacturers may face supply bottlenecks or price spikes, increasing production costs or causing delays. This could ripple into broader sectors, renewable energy costs, electronics pricing, even manufacturing slowdowns. 4. Shock to financial system and investor confidence. Investors who assumed silver was a safe haven may find their positions underwater or unfulfilled if paper claims cannot be converted to physical. Confidence in commodity derivatives markets could erode. Regulators may come under pressure if defaults occur, especially if retail investors or industrial consumers get caught. A broader reevaluation of paper metals, not just silver but other metals, could destabilize parts of the commodity finance complex. 5. Potential systemic contagion. If bullion banks, clearinghouses, or large funds face losses due to delivery failures or margin calls, The shock could spill over into other markets: equities, bonds, credit, especially if leverage is widespread. In short, this is not a mere metal price correction. This could be a structural unraveling of a fragile system built on paper. Failed fixes, why standard remedies may not work. One might ask, won't mining respond? Won't recyclers or refiners ramp up supply or regulators step in? Maybe, but there are serious constraints. As noted, silver production is mostly byproduct. Only 30% of silver comes from primary silver mines worldwide. New primary mines are rare, expensive, environmentally scrutinized, and take years to develop. Recycling silver is limited. Industrial silver, from electronics, PV panels, medical devices, is often lost or difficult to recover economically at scale. The incremental gains from recycling are insufficient to offset growing demand. For central banks or governments to step in with large silver sales or purchases is unlikely. Many hold gold reserves, not silver. And shifting reserves isn't simple, especially given geopolitical, regulatory, and environmental complexities. Synthetic solutions, like paper now converting into physical over time, are risky, because demand may continue to exceed what can be delivered. Market participants may not wait. Therefore, conventional market corrections or supply-side fixes may only delay or worsen the crisis, rather than resolve it. Modern parallels, repeating patterns and shocking data. This story is not new. The financial history of commodities is littered with episodes where paper markets crash under physical demand, or where speculation masked real scarcity. In the 1970s and early 1980s, silver spiked sharply, famously during the Hunt brothers' silver corner, then collapsed. But back then, demand was mostly speculative and not structural. Now demand is industrial plus speculative, which makes stakes higher. In the 2008 financial crisis and 2020 to 2022 commodity cycles, markets showed how leverage and derivatives can amplify shocks, but those were anchored in widely held, well-understood assets. Silver's risk is compounded by the paper versus physical disconnect. Today's supply-demand imbalance looks more structural than cyclical. A fifth straight year of global deficit. The recent dramatic rally, spot silver doubled in some periods in 2025, outpacing gold. At one point, silver futures exceeded $59 per ounce, a record. Premiums for physical delivery jumped, lease rates surged, backwardation appeared, and deliverable inventories plunged. Clear signs of a real squeeze, kind of not just price speculation. Yet many investors and institutions remain underexposed, underestimating the risk because the paper market continues to function for now. That could be a dangerous assumption, because once confidence breaks and the delivery demand cascades, markets may move violently, faster than regulators or mainstream media can digest. 3 clear takeaways. 1. The silver market is structurally fragile, not just cyclical. The imbalance between supply and demand, combined with mostly byproduct mining and weak recycling, means supply cannot ramp up quickly. Paper financial instruments amplify this fragility. 2. Paper exposure vastly exceeds physical availability, creating systemic risk. With open interest and futures contracts representing more silver than actually exists in vaults, the system relies on the assumption that few will ever demand real delivery. Once that assumption breaks, the consequences could be enormous. 3. Recent bullish forecasts from major institutions, e.g. Bank of America, should be treated as a warning, not just a speculative call. When large, reputable banks issue bullish projections, citing supply tightness and inventory stress, that suggests serious concerns from those who most understand market internals, not just opportunistic speculation. Final warning, open-ended thought. We may be on the brink of a silver market reckoning, one where the gap between paper claims and real metal becomes impossible to ignore. This could redefine how financial institutions, investors, industries, and even regulators view commodities risk. Because if silver fails, and it could, then the layers of paper built over decades might collapse, taking with them not just speculative positions, but real industrial supply chains and financial stability. The question isn't just, will silver go up? But can the system deliver real silver when people demand it? If not, this silver shock could be far more severe than anything seen in equities, crypto, or real estate. Call to action. If this analysis caught your attention, share this video with friends, hit the like button, and subscribe for in-depth coverage of hidden risks that mainstream analysis often misses. Keep your eyes open. Question what's paper and what's real, and don't treat every shiny chart as safe harbor. The true value lies in fundamentals, and in understanding what lies beneath the surface.